Hello everyone, and welcome to another episode of ACY Securities Economics. I'm Clifford Bennett, Chief Economist, and a little bit of a gloomy afternoon, so we're doing an indoors edition today. As is the nature of lockdown usually, we've been very lucky with what we've been able to do outdoors. Of course, it's a rather gloomy day for financial markets as well. We've seen US stocks and Australian stocks and European stocks, a lot of markets, fall rather significantly. We have the euro and the Australian dollar remaining very heavy. And I would suggest to you that basically these are trends that could well continue for a fair amount of time going forward. And what might be a mistake to view them as a short-term aberration. As with the previous sharp decline, I did say that it was a decline of such a quantum that it won't be over in the short term, even if we have a strong rally. We had that strong rally. US stocks got back about half of their overall decline and have started to fall again. The Australian market didn't manage to rally quite as much, but the absolute movement seemed significant and grabbed headlines. But it's all about proportion in these rather wild and crazy days, modern days of market behavior. Daily ranges and volatility is really significantly 3 to 4 times what it used to be back in sort of the pre-2016 period. For the sort of 30 to 40 years before then, markets had a particular kind of behavior. From around 2017 that changed very much in 2018. And of course, the Greek financial crisis was a significant factor in volatility around the world. And we've seen other things, of course, occurring. And we've got to remember too that the Greek problems the problems of Greece were a function of US investment banks overlending as they did to sovereign states with high risk in much the same way as they had packaged high risk bonds and sold them as low risk. So all roads lead to Wall Street. In the real world, of course, there's real pain. And that is being seen in the US now with reports of not widespread, but certainly the beginning of significant empty shelf experiences in a variety of shopping centers across the United States, and seeing footage even of over 100 ships waiting at anchor off LA, unable to get into the crowded port, suffering from supply chain disruption that spreads across the United States via the train terminal there. And all of this, of course, is largely driven by Delta. Now, the surge of Delta in the US is significant. Hundreds of children are being hospitalized every day. Of course, they don't have access to the vaccine in the same way as adults do. But there are continued strains even for the adult population now with this Delta surge in the United States. At the same time, at the other end of town, up there on the hill, as they like to say, in Washington, there are all kinds of problems. You have chiefs of staff and senior military officials testifying that they advised Biden to leave 2,500 to 3,500 troops in Afghanistan and maintain an active caretaker role in support of the Afghan troops, and that advice was completely ignored. So that's a real question mark over this presidency. Now, I've lived through a couple of examples where there was a delay in the debt ceiling. And just because there's a deadline, it doesn't mean these people in Washington are able to come to an agreement. Now, it should be achievable, but if it's not, and the Treasury Secretary yesterday gave a speech saying if the debt ceiling isn't reached, US credit will be downgraded, there'll be a financial market dislocation, and there will be real-world economic strife. She used terms more harsh than that, but I don't want to scare you. So if the Treasury Secretary is saying things like that about something that could happen in 1 to 2 weeks, of course, that is alone a lot of reason to be cautious about being long US stocks at the moment. And then on top of all of this, we've got bond yields beginning to rise, the inevitable rise of bond yields. And that is likely to be a sustainable trend. Even if they correct a little bit, that is going to be a sustainable trend. The overall situation is starting to sound like, with the president making missteps, not listening to military advice, debt ceiling problems, supply chain disruption, after an enormous amount of stimulus. Remember, last year the United States had injected into its economy via public borrowing the equivalent of 30% of annual GDP. And yet still we're seeing all the economic data in the US now rolling over. We're seeing manufacturing in some regions of the United States moving back into contraction, not expansion at all, negative growth. So the US economy is in very serious trouble. We're seeing in the UK that the system of targeted isolation practices for people who've caught COVID or close contact is leading to a massive shortage of truck drivers. There's queues at petrol pumps, there's empty shelving in the shops. It could well be the case that the US is headed in the same direction as the UK. Hopefully not as bad, but you know, a similar experience. So, weakening economy, dysfunctional debt ceiling deliberations, and a president who's being accused of not having followed his general's advice, causing the fiasco, and as a general testified yesterday to the Senate committee, a strategic failure, the 20-year war, called a strategic failure by the senior general in the United States Army. This is not a good look for a superpower. And it just feels a little bit like the end of the Roman Empire. And I mean, it is the case, and I've lectured on this for 10 to 20 years now, well no, 12 years say at the most, that we were well past the period where the United States was the lone superpower after the restructuring of Germany and Russia and all of that. And there was only one superpower in the world for a period, the United States. And we've moved to a situation now of 3 equal superpowers, militarily, economically, and diplomatically. And it's an unavoidable outcome of Europe forming a tighter bloc, and the NATO force there, the European force there, and the rise of China. And China is 24% of the world's population. So if you ever doubted that China would become a superpower, I don't know what you were thinking. One nation with 24% of the world's population modernizing is going to be only one outcome, and that is an equal superpower to Europe and the United States. But 3 equal superpowers might be a relative stability moving forward. It doesn't feel like that at the moment. A lot of tensions with China at the moment. But overall, hopefully, in the long term, it will be a more peaceful century. I mean, this time last century, we'd already had a world war. So, touch wood, I really don't see anything along those lines happening. So that's good. And that's supportive of a global economy. The problem is that we have rampant high inflation. The only way central banks can respond is to accelerate tapering and look to raise rates. But how do they do that when the economy is rolling over, weakening again? And I'm talking about UK, Europe, US, Australia. How do they do that when the economy is rolling over again? So we're getting a very strong, perhaps the most powerful historic burst of stagflation we will ever see, which is falling growth, rising inflation. Our central banks, I believe, unfortunately, do not have the experience or the ability to deal with this crisis. So we are in for a very rocky period in the months, perhaps 1 to 2 years, or even 3 years ahead, before all of this sorts itself out, shakes itself out, and begins to stabilize. What does that mean? It means enormous opportunity for people who see it coming before others do. Now, I'm not trying to be one of those doomsday type people, because I've always rallied against such information because I didn't think it was accurate, and it hasn't proven to be accurate at all. But now I think there is evidence of it, and it could be an accurate forecast that we do have a period of consolidation in a historic sense of equity markets. And that could be simply going sideways for 1 to 3 years, or it could be being a little bit heavy for 1 to 3 years. I would say at a minimum at the moment in the current shakeout, we are looking at a 3 to 6 month consolidation to heavy stock market period. And that's something to be very conscious of. In that period, initially, the United States dollar will be bought and acquired as a safe haven, and the mega corporations of the United States will be bringing funds back to the US. So that will support the US dollar. The euro will become a little unsettled in various political corners, and that will weigh on the euro. The euro will not collapse, but it will be a little bit heavy. The Chinese yuan, because remember we're talking about 3 equal superpowers, Europe, the United States, China. The Chinese yuan is probably priced about right. So I'm not seeing a lot of movement there one way or the other. I'm seeing the US dollar at first bought, the euro under pressure, but after a period of time, and I don't know whether that's 2 weeks or 2 months, we're likely to see the US dollar begin to weaken as the realization that the United States continues to see high goods and trade deficits, fiscal deficits, problems with even administering government in a smooth fashion. It just seems to be a dysfunctional system just for the time being. Of course, all countries go through that sort of wave-like period. And this is not going to be a good period for the United States. And the other problem for the United States has had various upheavals, and we all know what they are, of various forms, the worst of which is Delta, the rising worst of which is inflation. And really, there's no economic policy levers left to pull. There's no slash rates lever. Quantitative easing. Well, we've already had massive quantitative easing. Borrowing money and huge stimulus spending. We've already seen that. So it's a very challenging time ahead for the United States. And this comes very quickly after when so many people were forecasting it's going to be the roaring 20s. And I wrote, I think almost a year ago, that it was the roaring 20s for sure, but we're in about 1926, 1927, 1928, leading up to 1929. And that we weren't at 19, 20, 21, 22 and expect another 7 to 8 years boom. But that's what most people thought. And the reason I raise that is not to say they got it wrong. The reason I raise that is to just enforce how heavily invested so many people are. So many members of society who don't normally buy stocks or shares or invest in financial markets are highly leveraged to various asset markets. And that broad participation itself is often a warning signal that there is economic or financial market trouble ahead. Wouldn't it be great if the debt ceiling is resolved, Biden starts to become a clear and strong leader again? Remember, his opinion polls at the moment are tanking. And inflation were to suddenly subside as the RBA and the Federal Reserve had wishfully forecast it would, and that the Delta would totally give up its fight against the vaccines. Wouldn't that be wonderful? I don't see any of those things happening. So we are in for a period of time where you need to be active about your investment portfolio. Now, the great upside in everything I'm saying is, for instance, the Kennedy family. How did they become wealthy? And they became wealthy when in 1929 they sold all their stocks before the crash. And then, a year, 2 years later, they started buying property at 10 cents on the dollar. Now, I'm not saying that's going to happen this time. I'm not even inferring it. I don't think that's not even on the cards. That's not what I'm saying. But what I'm saying is they managed the downside, and that empowered them for the next bull run. And I think if we approach markets in that way, and look, if I'm wrong, we'll know pretty quickly. If the market were to get above the highs of the last sort of 3 to 4 weeks, we know this warning view is inappropriate and incorrect. But while we hold below those highs, and I don't think we'll be seeing them myself, and there's certainly immediate downside risk at the moment, while we remain heavy in the current price action, it would be a great idea to think about how you can make the most of this opportunity long term. And you could make the most of this opportunity. You don't have to take my word for it. You have to do your own analysis. You have to do your own thinking. The great advantage we have as individual investors is that we can think for ourselves. We can look out the window. I call what I do look out the window economics. And we can figure out for ourselves what's happening in the world. And it isn't particularly positive. It's not smelling of super profits at all. Corporate earnings have been up of late. That may not be sustained. And I forecast we would have strong corporate earnings, but stocks were overvalued. The reason we were having strong corporate earnings was that high inflation was a function of freedom of pricing, in that from the corner store to the global corporation, you could raise prices without losing market share. That hadn't happened for 20, 25 years. And that's what everyone was doing, and that's why their profits were going through the roof. It wasn't necessarily that they were doing more business, they just had fatter profit margins on the business they were already doing. That's why earnings have been strong. Going forward, those earnings are going to be eaten into by a slowing economy, higher unemployment, and higher inflation, meaning the consumer's dollar doesn't go as far as it used to, and they will cut back on some things. So that earnings run could be coming to an end soon. So look out the window, figure it out for yourself. I'm just giving you ideas, but it is actually a once-in-a-lifetime opportunity, or maybe it's the third one because we've had such big movements in markets in recent years, to third time in a lifetime, third chance in a lifetime, to take advantage of any market downturn to empower your investment power, should have used a different word, to empower your investment power into the future. Those who are strong at the bottom of a market are the ones who usually end up the wealthiest. I'm Clifford Bennett, Chief Economist, ACY Securities. Thank you very much for listening in, and I look forward to speaking to you in the next episode. Thank you.